Roku Strangle, Anatomy of a Trade. What I like about this one is that you've highlighted your delta adjustments as well.
Yeah.
We've got the visual, of course, the classic visual of management. So let's dive in.
All right, so this Roku position I closed this morning, and so this is the whole trade here. We started on the 12th, May 12th, so it's been a little over a month and a half-ish. Started with the 50-60 Strangle, stock trading around 56. Sold it at $2.67. Only used $600, $700, $800 in buying power. You know, a stock that I trade quite frequently. I'm comfortable trading it. It moves. It has pops and volatility. It has contractions and volatility. It's good little starter position for account in the $25,000 to $50,000 range. Definitely a good one to start with. Sold it at 267. You can see my break evens 47, 60, and 67 ish. Just standard setup here. It's basically a 20 delta short option on either side. You can see over the course of like a couple days, and I forget if this was an earnings trade or not. I'm going to say it wasn't, but it could have been at that point in time. Earnings were around that time, so maybe it was. But the stock rallied, the stock sold off a couple dollars over the next 3 or so trading days. I rolled down the call. I mean, I'm being pretty aggressive here at 31 days. You know, you could have rolled this out in time if you wanted to. I decided just to flatten out the delta here by rolling down the call. Did that at 217. You can see I'm collecting almost $5 in premium. My break evens are moving a little bit, giving myself a little bit more room to the downside into the move down, and reducing the upside break even in exchange for doing that. Couple more days go by, 5-6 days go by. I roll up the short put, so you can see I'm rolling back. The stock rallies back to 56. I got a week has passed. I got 24 days to go till expiration. Roll up the put for $1.64. I mean, the stock's moving $2 or $3 a day. So these aren't tiny little moves here. We're talking about 5% up or down moves in just a couple days. So you're definitely getting some movement here. Again, just collecting premium. It's high volatility. It's liquid. I'm just managing my deltas here. About 10 days go by ish, 9-10 days go by. I take this position, roll it out, and I roll up on the call side. So this is one of the adjustments that you can do with naked short positions. It allows you some flexibility, and I have another adjustment later on in here. But it allows you some flexibility to move and adjust your strikes because you're selling so much extrinsic value. When you're rolling out in time, that extrinsic value is even greater than if you're rolling in the same expiration. So I'm taking my position from the 55 straddle. I'm reducing my exposure a little bit, my short delta here, with the stock basically at 60 by rolling that call up $5 and doing the whole package at $1.25. So that roll up of $4 of intrinsic value didn't really cost me anything, right? I'm doing this at $1.25 credit. Synthetically, I'm taking off another $5 of intrinsic value, so I'm really getting like $6 and change in real value out of this position with that roll. Collecting more premium, $1.25 puts me at $7.73. You can see my break evens kind of going back to where I started here, but with a ton more premium than what I started with out of the money strikes as well. Of course, we get a 2-day move of about $10. We go from 59 to 68 and change. I mean, these are very, very big moves, and you'll see them on the chart when we get towards the end here. But, there's not much you can do into an $8, $9 face ripper to the upside here. I roll up the short put, collect another buck. I've now got the 60 straddle, and the adjustment I did on the 5th actually helped my position because I rolled to much higher extrinsic value at the money option rather than keeping that 55 strike call, which has intrinsic value and is a much heavier delta. So the adjustment in hindsight helped me, but there's nothing you can do against, a 20% move in the stock price in the span of 2 days. So I do that. I roll up the put. I'm sitting at the 60 straddle. I got $8 and change in total premium on the position, so lots of value to decay over time and hopefully collect. So jumping on to the next slide here, got a couple more adjustments. So after 4 or 5 more days, you have a move from 68 to 73. So we're talking about over a week or a little over a week. The stock goes from about 60 to the mid 70s, right? It's a 20 to 25% move in the stock price. I had to do something, so I had to go roll it inverted. I roll the put up. I go inverted by $5. You can see I have the 65 strike short put, the 60 strike short call. I have that $5 inversion again. I'm collecting premium, but I've now got $5 of intrinsic value that's on the table here. That's my inversion. It means that I can only make up to $4.88 on this position. $488 would be my best case scenario. It's obviously not what I'm targeting. I'm targeting to get out of this position, to scratch this position. I mean, keep in mind, we started this trade with the stock at 56. It's now in the mid 70s. Okay, so the stock's gone up 40 or 50% in the span of this 1 month time frame. My ideal situation here is to exit at a scratch. I'm not looking to profit on this trade. I just want to get out of this trade. I can reestablish it. I can move on to something else. This getting back to a scratch would take a $2,000 loser had I done nothing down to zero, and that's a huge difference. So the last adjustment I did was something that Tom likes to do pretty frequently, is buying the guts and then selling the wings, essentially moving the position from a straddle, a very high extrinsic value at the money position, to a lesser extrinsic value out of the money position, but one that will decay a lot quicker, because we know that the tail of the distribution will go to zero quicker. I'm buying the guts, the closer at the money position, selling the wings, selling the out of the money position. I'm doing this at a $6.75 debit. So slight debit. Really, my real debit on this position is about $1.75. And that's because I'm taking off that $5 of intrinsic value that I otherwise would have had to take off at some point. So the $6.75 debit is really a debit of $1.75 because that $5 is getting pulled off the table as well. Of course, moving the break evens, 56 and 73. Stock's trading at 64. It's right between my short strikes. That's the best case scenario for the position. Best time to do this sort of adjustment. And then today, I ended up closing the position. You can see the stock stayed kind of sideways over the last 4 or 5 trading days. And I closed the trade out for a 32-cent loss, or $32, after watching this stock whipsaw around.
It was absolutely nuts.
Yeah, it was a nice little adjustment, and this is kind of a example of the context that we use when we say, you're not going to be able to get out of this position in this expiration. Like, you're going to have to fight this position to get back to zero. You got to stay small enough to be able to fight that position, to be able to roll up and down and roll out and buy the guts and sell the wings. Like, all those adjustments hinge on having a small enough position to where you can hold the position into moves like this.
Yeah, and when you're managing these positions, the expectation of getting out for a scratch or profit is completely dependent on how much credit you have relative to whatever the position is. So in this case, when you have you went from a inverted strangle to a regular strangle, you paid a debit, but you still had a $3 credit with the 10-point out of the money strangle. So when you have a credit of $3 on a $60 product, you have the ability to get out for a scratch or profitability in this cycle. If it was only like $1 or something like that after buying the guts, selling the wings, maybe we don't do that. Maybe we just keep the inversion. Maybe we roll it out in time as well. That's what we typically do, is we'll roll it out in time and then we'll buy the guts, sell the wings, which is doing the same thing, but adding more time to the position to beef up the credit. But in this case, you didn't need to, because you already had a $9 credit, and you saw that the debit was $6, leaving you with $3 and change, which is a feasible amount to decay in the same cycle.
Yes. When you get to that, like, if that was a $1 credit, I would have had to roll this, like a net $1 of extrinsic value, positive extrinsic value through all the rolls. I would have had to roll this another cycle to get out of this for a scratch. At $3 and change, that's typically what those strangles trade at. I mean, just for reference, I started the position at $2.67. for the
Yeah.
strangle, which was at way lower strikes. So I'm basically back to that point, but with the stock much, much higher. And we could see that in the visual here on the next slide as we look at all these adjustments and the risk profile and everything. So we started in the mid 50s, and this is kind of I wouldn't call this, for lack of better words, tail type events. I mean, you don't expect stocks to move 40, 50% in 30 days, but having high implied volatility, it allows you the flexibility to manage this position, move your risk. And again, when you think back to the original strangle that I had and the amount of extrinsic value I had on that position, it was the same amount of extrinsic value that I stayed with at the end. So all the adjustments allowed me to kind of track the stock price to get to the same point where I was at when I started the trade. Like selling the 20 delta strangle with the stock at $53, having the same value as selling the strangle at $63. Like it's the same sort of position at the end of all these adjustments, but it's another one where some people look and say, well, you should have just done nothing and rolled the whole, the strangle the whole time. And that's certainly something you can do if you can take the heat up to 75. Like if you can take the $8,000-$9,000 pain to the upside and then play it to the downside, then fine, you sit with it. But for me, I like to just be mechanical and reduce my delta exposure, and that's what we'll get to on the next slide, unless you have something to comment on this one.
Yeah, I think it's really just a matter of there's always that, I could have just done this, but
what happens if the stock goes from 75 to 100? Now you're just
done.
Yeah.
Now you're just short stock.
Yeah.
And you might not want to be, where this is a much more neutral extrinsic value focused trade rather than a directional stock price trade, which is what would happen if you did nothing on the definitely outside the expected move from 55 to 75. The current expected move for 200 days out is 20 points.
Yeah.
And that you realize that in 2 weeks.
Yes.
So you have to do something, and it just doesn't make sense. Like if you had a short put on and we're seeing this rally to 75, if you did nothing, your short put's worthless. So there's no reason to have that on. And then if you just leave the short call on, again, you need a directional move in the stock price to be profitable, where when you're making these adjustments, as you can see by these green dotted lines, you don't need a directional move in the stock. The stock could have stayed at 75, and over the course of a couple cycles, you would have pushed your break even up to the stock price rather than needing the stock price to come back down to your strikes.
Yeah.
And that's the big difference, is focusing on what you can control versus what you can't. And what you can control is where your break evens are, where your risk is, where your strikes are. You can't control where Roku's going to be in 3 weeks and 2 hours. You'll never know. Nobody does. So what you do know is, what can I do to manipulate these strikes? I can roll this out in time. I can buy the gut, sell the wings, and roll out in time. I can do it in the same cycle. And that's what you did. You put your break evens where the stock price is, and then a couple days pass and you're able to close it.
Yeah, and going back to the where I go inverted, and that's like the point that people have the hardest time making that adjustment. And at that point, the risk reward moving forward is if I had not gone inverted, you have more risk to the upside because you don't have the same sort of delta protection. You're not reducing your delta exposure. You're leaning short. Of course, the stock comes down and I would have been better off not going inverted. But that's the question you have to ask yourself, is like, okay, if the stock keeps going up, my losses are going to get bigger and bigger and are going to move more volatile. The P&L, the loss is going to be more volatile to the upside just because you're getting more statically short delta. You got to kind of make that decision on your own. And for me, it's easier to just reduce the delta and play it neutral, because I know even if it continues higher, I'll just roll out to the next expiration, adjust the strikes a little bit and flatten out the delta and continue to move it along as the stock bounces around.
I like it. Delta slide. Yep.
Yeah. So this, because we get the question all the time of like, when do you make the adjustment? What are you looking for? What are you doing? for me, I'm always trying to, if I'm starting out with a strangle at 20 deltas or 25 or 30 delta on either side, and I'm basically flat delta, I'm not trying to do like micro adjustments to where I'm always at zero, right? You got to kind of take a little bit of heat on either side of this of the trade, but at a certain point, you want to get back to a more manageable delta. And all of my adjustments throughout the duration of this trade, I'm usually adjusting when I'm 40 deltas or 50 deltas or 60 deltas, somewhere around that range overall. Meaning I start with 0 delta, stock goes up, and my put goes basically to a 0 delta or 3 delta, 5 delta. My call is at a 50 delta or 60 delta, where I'm net 50 to 60 deltas in one direction. And at that point, I'm rolling whatever the untested side is, the short option, I'm rolling that up or down to collect around 20 or 30 deltas to get me back to a 20 or 30 delta position rather than the 60 delta heavy position. And this is all of my adjustments, my net delta after the adjustments. And you can see, all of my adjustments put me back to somewhere between 30 plus or minus deltas on this position. I'm never, I'm not waiting until the delta of the position is 90 and then adjusting. It gets to 60, maybe 70, and I roll up to the 30 delta put. If it gets to 70 long delta, I roll down to the 30 delta call. It's a mechanical process that collects premium, reduces your delta, makes you flatter on the position, so you just kind of need the stock to cooperate for a period of time, and you can exit the trade and scratch it.
And that's really the key here, is that your deltas were between 30 and positive 35 and negative 35, which means you didn't need the stock to do much. That's the difference. If you wait till your delta's at 90, you're done. You need the stock to sell. And if it doesn't, you're just stuck.
And that was the point I was making with the inversion, is like at that point you have to say, okay, am I fine with being short 70 deltas here?
Yeah.
That's the question, because if you get the continued move to the upside, now you're short 90 deltas, and every dollar move is 1-to-1 against you or for you. I'd rather flatten it out and
focus on extrinsic value.
Focus on extrinsic value, let time do the work for me, etc.
A couple of questions from the YouTube chat specific to this. What made you roll down the call if your put was not tested? Likely a delta adjustment?
Yeah, a small delta adjustment. At that point, Roku is a stock that has a lot of extrinsic value. So when you see this $3 or $4 down move, those options get cheap quickly, right? And the rolls, I'm not doing rolls for 30 cents or 40 cents or 50 cents. I'm getting dollars.
Yeah.
For the reversal against you doesn't hurt as much because of the high extrinsic value that's in that stock. If you're trading something like I don't know, when we were going through the S&P 100, like looking at WBA, if you were short puts there, those whacked you.
Yeah.
Because this is a low volatility stock. I mean, it's got 29% implied volatility.
Yeah.
If you're short puts in Roku, you're not really getting hurt on the downside, but your calls are getting vaporized.
Yeah.